Hey guys, it's Jay. Welcome to the Special Situations Research YouTube channel. Our goal is to provide the best educational content available for you on investing and the capital markets. Here, you will find free educational materials on a variety of topics and asset classes, as well as recordings of our public Twitter spaces that cover broad macroeconomic strategy and market events. For our company asset allocation, with respect to cash, money markets, bonds, preferreds, and individual equities, and special asymmetric ideas around income, closed end fund arbitrage, value and growth stocks, merger arbitrage, spin offs, split offs, and dual class share arbitrage, visit our website at specialsitsresearch.com. Also, you can join our Discord for our weekly live idea focus events, some of which are shared on WebEx. Both the website and Discord, which is where we host live events, can be found in the description box below.
Hey guys, thanks for tuning in. Enjoy the space.
Beautiful Sunday evening and a lot going on. We have earnings season next week. The banks usually start, and we're going to get a lot of information from banks next week. Outside of that, I mean, when it comes to economic data, we also have CPI, which we've been talking about for a couple of weeks now, that could come above 9%. It took a while for economists to catch up to our forecast, but it looks like consensus for the inflation basket is already 8.8%. So, we were pretty close, and I think it'll probably surpass the 8.8% because of OER. And yeah, I mean, commodities have come in, but gas commodities, represent a much smaller bucket, whereas real estate represents above 30%. The commodity categories represent less than 13%. So I think it'll be interesting to see how everything unfolds. Uh, I think we've also had some really interesting dynamics unfold in the auto market. I'm going to be posting a couple of tweets up to the top here to share. But we've had auto delinquencies. The biggest, auto lenders are obviously the banks and, in-house lenders at places like Ford and GM. But Ally, ALLY, is one of the biggest auto lenders in the United States, and we've seen delinquencies go up from like 0.4% to over 4.5% in for the best states, which is Utah. And we've seen delinquency rates, 30-day delinquencies, go above 23%, which is terrible for the auto sector in places like Washington DC from 2% 2 years ago. So I think we're already seeing a surplus of used cars in car lots in places like Vegas. And there are, other parts of the country, like the Northeast, where there's still, where car lots are getting filled up, but there isn't a big surplus yet. And they're actually importing vehicles from Vegas. So there are geographic imbalances right now. So you aren't seeing a huge shock to the system with a big decline in car prices. But very soon, I think you'll see within the next, few months, I think you are going to see car prices fall at a rate we haven't seen since 2008. And this has a lot of implications for consumers, because if you think about it, in the first year you see a car depreciate by 40%, and you're not amortizing the loan down that quickly. So within the first year, especially if car prices stop going up, the idea was that car prices were going up, you're underwater, you can't sell the vehicle, you have to sell it at a big loss. So we're going to touch on maybe 5 minutes on what's happening in the used car and auto space and what that means for OEMs, whether they're EV OEMs or ICE OEMs, as well as for a lot of the banks that service that market and the securitization markets, just like we did for the housing market. The used car market is 1.8 trillion and plays a huge part in ABS securitizations. And hedge funds, mutual funds, insurance companies have a big part in that. And we're also going to be touching on Twitter. I mean, Twitter has been an outright fiasco. The termination that Musk announced, already, you know, Twitter's chairman of the board has already, brought in, to fight the case in the Delaware Chancery Court. They've already hired Lipton, which is one of the best M&A lawyers to fight the case. And to be very frank, taking emotion out of it, it doesn't matter what you think about Musk, doesn't matter what you think about Twitter. The the Delaware court is probably going to favor Twitter, right? So how does that play out? Our standalone valuation for Twitter is like 25 to $30 a share, just given the decline in social media names. Snap down 50, Facebook down 30. Um, Usually in recessions, you see weakening of the advertising market. It's the easiest thing for companies to cut out of the budget, especially if sales aren't going up. So what are implications for, if Twitter goes to kind of our fair value, you're essentially, buying it. Right now, it's still well above it. But if you were to see some catalyst or some reason why it heads lower, you could be buying a company with an interesting call option where, this court case may actually not last very long given the 3.5 week turnaround of Musk. And if you read through the merger agreement, section 6.4, which we'll go into in a little bit later in the call, he doesn't really have a lot to stand on. So the court case may not last very long. You might get, within 6 months, some preliminary ruling. So that's also a very exciting topic to go through. We also had, a home run last week with Tenneco. We've been talking about merger arb now and event-driven situations for weeks. And Tenneco was a deal where the merger arb spread was almost 30%. You're buying the company, Apollo is buying the company for a single digit multiple. And 2 weeks ago, we alerted again, Apollo agreed to do the financing. Not only was it buying the stock, even though the bond market was shut down, Apollo said, they would tender for the bonds. If Apollo is backing the financing and they're buying the equity, and the antitrust risk isn't there, there wasn't a lot of risk in the deal. So on Thursday, this was up 11%. The spread is compressed almost 20%. If you're using calls, obviously did a lot better. There's some users that we have that have had several 100% returns, but the ARB space is still ripe. Sanderson Farms was another really interesting deal. Citrix, I think, is one for a round trip. So that's been a really exciting area for us. Today's Sunday. We also published a primer on the mortgage market, agency securities, preferreds, with high single digit yields where companies are buying back preferred stock, common equity with, 12 to 14% dividends, where areas where the sector hasn't bottomed out yet, but to put on your radar. We've also been talking about energy and ways to play energy without as much price exposure. So interstate, intrastate, so within a state and outside of a state pipelines that transport natural gas and oil, where they're paying high tariffs. And these companies are paying out 8 to 10% dividends after delevering by several billion through the pandemic. So their balance sheets are a lot cleaner, and they're actually generating free cash flow for the first time in 20 years. So we've been finding opportunities where you can buy funds, diversified pools of those at 20% discounts to net asset value. We highlighted three and then shared some additional information today. And we've been continuing on the massive arb in SPAC shorts. We published 5 new 180-day unlocks where management is allowed to sell their shares, along with the venture capital and private equity firms that were part of the original syndicate. And we've also been updating our pipe unlocks with 2 pipe unlocks coming up where the float is going to increase between 500% for one and 1,800% for another. So there's surprisingly a lot going on, for a summer week. And, I think in the next couple weeks, we're going to be focusing more on individual earnings. But for now, we have a good group of guest speakers up here. We have more than enough information to go through for the next couple hours. Want to have some time for Q&A. And let's start with what's going on in the used car sector, and then jump to this Twitter M&A fiasco, which I actually did post a really unique thread on what the outcomes could be in the Delaware court. And in the next 30 seconds, I will post that up to the top so that you guys can take a look at it. And it starts with this Skadden letter on Friday, which is a separate thread. And there are also some sympathy plays. I know that Stock Talk Weekly likes to talk about sympathy plays and comps, but Tesla for one had rallied after this Twitter deal was terminated, because obviously there was less margin risk in the beginning, because Musk wanted to restructure the financing of the deal. But now there's little risk that it's going to affect both his time and there is no margin loan if there's no deal. Now, we think that Twitter could win, but at least in the near term, there's a pop in Tesla. We saw DWAC up 15% right after the deal was announced. It could be setting up for another bearish trade. It was up actually 30% by 7:59 p.m. We saw CFEI Rumble, which is less, it doesn't have the same risk as DWAC, and it was up, 3.5% at 7:59 p.m. after hours. These names could run later next week because the idea was that, Musk could allow Trump back onto the platform, could allow more free speech. And it looks like you're going to need these secondary and tertiary platforms. As you saw Trump really lash out at Musk over the weekend. And regardless of whether this deal goes through or not, it looks like, Trump is not going to be on Twitter for a while. So, I don't want to spend too much time on this topic right now. Let's go to the auto topic. That seems to be what everyone is interested in and what the implications are for the economy. And then we can go back to the Twitter conversation, which I think is going to be one for the history books. So the average used car payment in the United States rose to $600 per month during the pandemic, and part of that was due to car prices rallying, over 30%. And this is one of the reasons why our Hertz trade was a home run because I was actually involved in trading a lot of the Hertz securitizations, like the B pieces. And, a lot of these, whether it's Hertz or Avis or other players in the market, they essentially had off balance sheet debt, bankruptcy remote vehicles where they essentially house their cars and the lease cash flows coming from those cars. And they use that to pay down the debt. So when you looked at these companies, they had a lot more debt than people realized going to the pandemic. And what we first realized is that these securitizations were covered because even through August, September, after the initial pandemic, car prices were already up 12 to 15%. So they were all covered, and there was value left for the operating business. So it's one of the reasons why Hertz equity was such a home run, not just because rental car prices in Vegas, Miami, New York doubled and tripled. It was because the used car market was so tight, and AutoSAR had declined so rapidly. There wasn't enough inventory to replenish. Now that's changed very quickly because what we've seen is that the sharp increase in the price of cars has resulted in the average car payment going up dramatically. And I'm not talking about luxury cars. I'm not even talking about mid-luxury like Tesla. I'm talking about Dodge Chargers, Chevy Malibus with car payments of $900 to $1,000 a month. Now, how are people affording these cars all of a sudden? It was, transfer payments and just like in the mortgage market in 2008, where there's no doc lending, the mortgage market is stricter today than it was back then. But in the used car market, it's not as regulated. So these used car financiers were essentially saying, you tell me what your income is, right? Just like 2008, you tell me what your income is. I don't care if it's from government transfer payments. I don't care if it's from a side gig. I don't care if you're frankly lying. I don't care if your bank balance is higher and you're able to make a down payment because you simply aren't paying rent and you're lying to your landlord and you haven't paid rent for 6 months. So what was happening was a lot of car buyers were able to put down 20% down payments. And the moment, I mean, you've been to car dealers, the moment you put down a 20% down payment, they automatically think you're responsible, right? You've been budgeting, they give you bigger loans, bigger and bigger loans. So all of a sudden, people that couldn't afford Honda Civics, right, are buying, 60, 70, $80,000 cars with $1,200 payments by putting, a good amount down. And the real incomes are only like $4 or $5,000 a month, right? And what's happened since then, we've seen, rents up in the United States by 23%, data from realtor.com. We've seen grocery prices up 30%, and we've seen utility costs double, right? So from all three angles, right, we're not even talking about other buckets. People are getting hit with real inflation, and the rents are going up, and some are being forced to pay rent for the first time in 2 years as eviction moratoriums go away. And this has a lot of other implications for consumers. But there are people, okay, and this is coming from dealer that I bought my car from with 700 FICO scores, not subprime, not under 620. And keep in mind, FICO scores or credit rating scores are much less accurate than they were before. Some might say for the better because they don't include medical debt, they don't include tax liens in the same way they used to. So, you pay your bill and all of a sudden your credit scores goes back to where it was within 1 week if you call one of the credit rating agencies. So it's a lot easier to have a higher credit score. And these prime borrowers with 700 credit scores for the first time are defaulting on car loans, and they're just walking away from cars, right? And they don't care about the hit. But as the cost of living has increased, you're starting to see things that you haven't seen since 2008. So, one thing that we had talked about was that in the mortgage market, underwriting is actually a lot better than it was in 2008, and banks don't actually take a lot of risk in that market anymore. They've disintermediated that risk, and a lot of the loans that are given are actually banked by Fannie Mae, Freddie Mac. They're government-backed loans. There's not a lot of risk even in the securitizations, apart from MBS spread risk and interest rate or duration risk. There is risk in the non-QM, right, non-qualified mortgage market, right, for bigger homes, but for the average home in the US, you have government-backed loans. It doesn't work like that in the auto loan market. So there's a lot of risk there, and you essentially have banks buying loans from one another. And it's pretty incestuous. Everyone's trying to make 2, 3%, then offload the risk. But in the end, just like musical chairs, someone's going to be left with the risk. And this short-termism is going to come around and is going to hit people in a way that I don't think they expected. So a couple of other stats that I wanted to share, just so you can understand kind of the gravity of what's happening in the auto loan market, is that you're already seeing multiple loans defaulting. You're seeing families with, defaulting on 2, 3 car loans at once. You're seeing arbitrageurs that essentially took advantage of the rental car market, just like, the Airbnb folks in real estate, and they bought multiple cars and they started like small taxi cab and rental companies, in places like Florida and in Vegas and in Texas, where these are private companies. And they're working really well right now because there's still an Uber driver shortage and a Lyft driver shortage. But at some point, these guys overpaid for these vehicles. And who knows where the prices come down, whether it's 20%, 30%, 40%. At some point, the private market, will have to capitulate. And, it happens very slowly and then it really happens all at once. So, I mean, none of the data that we have is anything surprising. This is just data that you can find on, if you have a subscription to Experian, you can get state by state data, and the data is pretty accurate when it comes to delinquency. So, we'll kind of leave it there. And I know we have a couple guys in the panel. See if they have any questions, comments, and, then we'll move on to the next topic. Stock talk, stock market. Emma, A stocks, did you have any kind of thoughts? I know Disruptor has spent a lot of time on this. I could bring him up as well.
So I think you hit it on the nail on it. Especially with people who are walking defaulting. I think that's the trickle effect, right? And I think what you said was best. I agree with not the luxury market, the used car like me, the Camrys, the all the other. If you're in this boat, right? I think what I'm trying to capitulate is what happens next, right? You're in this situation where folks are having to have their cars repossessed, right? And you've got the inventory lots, right? And I think last month, other than Tesla being the one company outlier, every single car manufacturer posted on average a 20 to 40% decline in sales off their lot across the board. So they, I think, are going to react a little slower off the new lot after other cars start to come back from already purchased. And I think you'll see that trend continue next month because generally they wait a little bit longer before they start seeing the price decrease. So that's just my.
Okay, well, that's really helpful, and I thank you for sharing that insight. And before we go on to the next topic, someone had asked. Actually, KP had wanted to share, and then we have another topic on there's 6 important economic events happening next week that we'll jump in right after this. So KP, and then I think
Hello.
David's requesting.
I had a deal on the Tesla. I mean the Twitter cancellation. I read your post about that it could be revised lower, similar to the mall Simon Mall deal when they were making an acquisition. How if that were to happen, what's the timeline of that playing out? How long did that one take for that to happen, and what's your estimate there?
Yeah, so these deals take several months, and it depends on, the jurisdiction, and it depends on the judge that is seeing the case. And I frankly think that cases might resolve themselves faster post-COVID because the courts were really backed up. during COVID. And I think that it's one thing that, I wish I spent a little bit more time on, but I frankly don't think that this case um, would take anything more than 6 to 8 months. It depends on discovery, right? So Musk can spend time on discovery and ask for time and say, hey, we're really trying to figure out this bot situation. But all the data, it's up to Twitter itself to share the data. And to be honest, after the behavior that Musk has shown, Twitter is less likely to share, important data with Musk. And I'm just posting this thread up so that everyone can see it. Um, Twitter is less apt to share information with Musk. So he's kind of put himself in a tough corner. Um, it doesn't matter, to be very clear with Twitter. It doesn't matter what Twitter is worth 5 years from now. It does not matter at all. In a matter of 3.5 weeks, Elon Musk realized that he overpaid for Twitter. It was an economic decision, and it was not an altruistic decision. I know he believes in free speech, all that stuff. It sounds beautiful and wonderful. It is what it is, but he realized he overpaid by $20 billion. And he's not a dumb person. Within 3.5 weeks, Bill Gurley, even the most bullish VCs came out and said stocks are overvalued. Chamath, Mr. Chicken Legs himself, like the most bullish person who's resulted, he's resulted in, a lot of equity shareholders in his D-SPACs losing 50, 60% of their net worths. Like look at Clove, right? As an example, down, 80%. He is now blaming Wall Street and saying that they're late to bringing down estimates, something that we've been pounding the table on for months. So the stock bubble has happened, right? And Musk, for as bright as he is, he kind of missed the boat, and he bid a price 54.20 that nobody else would compete with, and he knew that. Um, and at this point, the fact that it was such a quick turnaround actually works against him. And the two executive firings are more, akin to like an MAE than, this bots issue. Because Twitter, if you read the 10K and the 10Q on SEC Edgar, they already disclosed that their estimates for bots could be dramatically wrong. Now, whether that, an MAE, you've only seen, going back for the last 20 years, you have only seen one deal invoke, an MAE clause. And this was Tyson Foods IBP. Um, and that was that was there was a specific remedy there in 2001. I'm sorry, so that was a specific performance. There's one deal where the deal was completely canceled, and that was in 2018. It was Acorn Fresenius, and that court case took several months. But the only reason it was completely terminated was that Fresenius had lied to regulators about both its regulatory status, with the FDA, and its actual financials. Its financials were not properly audited, so that was a double whammy. Like with Twitter, one can say, this is what was a $30 billion company. I know that the bots issue might be relevant, but there's obviously, their revenues and EBITDA, aren't completely farcical. Whereas with Fresenius, it became obvious that they had lied. So that was the one deal where it was breached. In what I've posted up to share with you guys is there are many remedies that that you can see after these M&A deals are terminated. And with subscribers, we shared data for the last several hundred deals, and usually only 10% of deals that are litigated result in the buyer paying full price, but 40% result in the buyer paying a lower price. So we might have a situation where maybe this is what Musk wants, but the Delaware court forces him to pay a renegotiated price. In addition, instead of him just getting away with the $1 billion breakup fee. So there are three pre-termination equitable remedies. There's something called full specific performance. That's where the target company has an unconditioned remedy of specific performance to enforce all the buyer's obligations under all circumstances. This includes enforcements of the buyer's obligation to draw down the debt financing and equity financing when applicable. That's like 10% of cases that go to court. Then you have conditional specific performance when the target company can enforce a buyer's obligation to fund the financing and close the deal, but with a condition that the proceeds of the debt financing are available. Now, I don't think that's as relevant in this case, but because Musk has the net worth and the ability to close the deal, And then there's no specific performance where the target has no right of specific performance and the buyer does not close, which is also rare, especially with Delaware court. And then there's also breakup fees. There's you can essentially receive damages for willful breach, which can also be several billion dollars. I don't want to get through all that on this call, but there are a couple other cases that we can talk about, especially during COVID. You probably remember French retailer LVMH threatened to walk away from a deal to purchase Tiffany. And this was, in all the media press, CNBC, Bloomberg, Reuters, etc. LVMH, ultimately agreed to lower the price by 425 million, as the court found that hey, they had signed the merger agreement, and we'll get more into the merger agreement and why it's so important and what a contract actually means in this context. But 425 on what they actually ended up paying, which was 15.8 billion, was only a 2.6% concession. So that is something that I think it is very important. I think it's very important to consider, that for a lot of these deals, by the time a buyer is trying to get out, it's too late. When Musk signed the merger agreement, he waived his right to due diligence. And you can actually go to SEC Edgar, and I think I posted the merger agreement. I'll try to post it for you. I would go to section 6.4 of the merger agreement in plain language, and it includes a section called information rights. And in the information rights section, you can see that Twitter really isn't liable. If Twitter chooses not to share additional information with Musk, they don't need to. But because Musk essentially waived his rights, to due diligence, as he entered this deal, he will have to close this deal. It's not a financing issue. He has the capital to close the deal. And, at the very least, I think what, his counsel could be telling him, and he's hired Skadden, another top law firm, is that, he can probably get away with lowering the price. Now, if you think about the board has no choice, right? The board has no choice but to hold Musk to the original price. But what may happen is 6 months down the line, especially if the economy gets weaker and valuations come down further, right? The board must realize that the fundamental value of Twitter, it doesn't matter what Twitter is worth 5 years from now. That's not, the judge isn't going to care about that. The judge, in terms of the judge's also, it's not the judge's duty to figure out what the right bots number is either. There's a chance we never even find that out. What is relevant here is, did Twitter materially change the business, right? Did they commit fraud? And did Musk sign this deal knowing what he knew, going into the deal? I don't know if you guys remember, at the time the deal was struck, people were saying Twitter's board should block the deal. This is a great deal for Musk, right? This is a one of a kind asset. He's doing what Bezos did with the Washington Post, right? This is unprecedented, right? He's going to control free speech. Like this is, and what really was happening was that, Musk figured out a price where he wouldn't get any competitive bids. And, he knew he was paying a premium. What he didn't realize was the advertising markets were going to roll over, and every single social media company was gonna re-rate, because you saw earnings, very shortly afterwards, a lot of these companies were down 20-30%. And something, another example we can talk about, is the Boston Scientific Channel Med Systems deal. Um, and what might happen is, if there is compensation for Twitter or damages of several billion, Twitter might be in the case where the deal where they agree on some sort of a settlement, they might have to do some sort of an accelerated buyback or another type of shareholder friendly action, to support the stock price. So all in all, what the conclusion is, if you're looking at this situation from the sidelines, I think what we'll see is, if Twitter's share price were to fall in kind of our fair value range of 25-30 bucks, there might either be shareholder friendly actions coming from Twitter in the case of a settlement plus break price. It won't just be the break price, or more likely the judge in a Delaware court, this is dragged out for several months, and the judge forces Elon, to close the deal at a lower price. Now, this isn't financial advice. We aren't providing any legal opinion. This is just using historical cases and precedent, which is what lawyers do to paint a picture using mosaic theory. And I wanted to provide this commentary, just so that people have a fresh, unbiased view. Because right now I have no ownership. I actually own zero Twitter stock. I am not short Twitter stock. I have avoided this disaster. I actually did own Twitter stock last year and sold around $70 a share, which you can find on my timeline. And then, was involved for a very short period in the ARB and have no exposure. So there's no vested interest, but there are a lot of biased views, including views of people who are even on boards of related companies who don't seem to understand, how the law works and, what you actually are liable for when you sign a merger agreement. So I know there are going to be a number of questions about this. Happy to kind of field any questions and comments. Three aces.
Hey, brother, the killer space. Thank you for having me.
Thanks, man.
Sure. I've spoken who are C-level guys who've been involved in like this as executives. I've looked at probably M&A, sort of lawyers and opinions and stuff like that. I think unanimous, the consensus that I'm getting is that under no circumstances Musk can win this. It's just no chance. But the question is, right? So is that nobody has a real good feel for how it may go. If it goes specific performance, Musk is most likely personally bankrupt. So the other thing is these kinds of cases from what I'm being told by executives who have been in them in this chancery court in Delaware, they move very, very. This is not a case that's going to go on for 6 or 9 months. This is a case that may go on for 6 or 8 weeks. This court is built specifically for this because remember, Twitter's business now shut down. Their advertisers, employees, everything is just at a standstill. This imbecile was having Zoom calls with the entire company a week or two ago, pretending like he owned the thing, right? So this is a very serious matter that you have here with regards to Twitter's business. But I think the things that people aren't paying attention to that are related to are, for example, so Musk owns 162 million shares, okay? Roughly around this price, it's about 115 billion. Right. So, but he has a $1 billion loan outstanding already against those shares. Right. And the board to where he can only borrow 20% from his shares. Right. Which is $22 billion roughly. So if you take the $22 billion and you back out the 16 that he's already got. OK, that leaves him with access to $6 billion in equity that he could use. So by most, assuming he still has the debt, he's still got to come up with another 25 billion or so, give or take taxes. Now, the last time he moved the stock down dramatically, right? So if this guy's got to come up with $25 billion in this market going into earnings, and with a gun to his head with the whole world there, I mean, he might have to sell 40, 50 million shares. I mean, he's not getting that sale off at $700, at which point he may even start triggering calls for his $16 billion loan. So, he's really got his, like every other lie, that he's told, which is basically everything that's ever come out of his mouth. He's obviously gotten away with, to his credit, right? That's the world we live in today, right? The golden age of fraud. But in this particular case here, it's indisputable. There is no waiving dues. There's no $1 billion breakup fees. There's none of that. He signed a binding final merger agreement. All of that stuff's irrelevant. So he's toast in that regard. The question is, what's the remedy? And that's probably what the next couple, 2-3 weeks we'll be debating here on Twitter, on Spaces. And for the guy, Tesla's the only company that sales grew last quarter. BYD is now the world's #1 selling EV car maker. They sell 2 times the number of cars in China. So I don't know if he was talking about in America or where he was talking about, but just wanted to clear the record up there. Thanks for having me.
Three aces, thank you. I always love having you up here. I agree with all those points except for the fact that he would be bankrupt. I want to keep it kind of two-way. I know that some people like him, some people don't. I mean, even if he can't borrow against those shares, I guess he could sell further shares. It's not good for Tesla. But in one way or the other, I think if he needed to, to sell equity, there'd probably be some way to do it instead of borrowing, and that would be terrible for him, right? Because he would have to pay taxes on it. The reason why he's
Yeah.
borrowing is so he doesn't have to pay taxes.
Right, but
Um,
if you do the math on shares that and what he's allowed to borrow, right? There's a number in there, probably in 480, $500 range, which this stock could see on Monday morning, given how stupid the move that he's made here. It's just a cascade because it kicks off a margin for, if he's got to come up with, if let's say he lost the debt, he's got to come up with $30 billion, right? How many shares of Tesla is that at 400 or 500 bucks a share? It's not. He's not selling 60, 70 million shares of stock here. It's
oh,
way
I agree with
lower,
that.
right? And
Uh,
then what happens? He then triggers the margin call for the other 16 billion. Remember, he's got $16 billion loan already against his stock. That's where it's not just from this. It's like a cascade effect. You follow?
yeah, I mean,
Right.
I still don't think he would have to file. I mean, just look at his net worth versus the debt. He might be forced to liquidate, and it's very unclear. I mean, we could say that it goes 400. The stock rallied after this deal was canceled, so I don't know if it provides him an opportunity to exit or whatever. But I think he has enough liquid net worth that even if Tesla fell to that price, he could. I mean, at some point, he could sell enough equity to cover himself. I just don't like the word bankruptcy because I've been a bankruptcy distress guy for years. I don't think like he would actually have to file. I frankly don't think he would, but I do think that he would be in a very dicey situation where he could have to liquidate and destroy a lot of his net worth. I do think that that is realistic to share. Because I think he is a very smart person, but he's gotten away with murder. I mean, the stuff he's been able to get away with the SEC, I don't think anyone else would be able to get away with. At some point, you get caught and you get stuck in a situation where I don't think the Delaware court's going to let him get away with this. This is not, you know, the same thing as saying funding secured and then, tweeting to 50 million people to take your side, paying, and, having the SEC back down, signing a non-disclosure, and then bad-mouthing the SEC after that. So,
Yeah.
um,
I just did the math, Jay. So remember, so you're talking about a company that is basically a stock promotion. That's all it is.
right. But
Okay.
then what
Right.
you're talking about the stock price and not, if
Well,
you're
but
talking
hang on
about
for
the
a second.
stock and, I don't want to get confrontational because I'm in the same camp as you are, but there are
Yeah.
also people who, you know, believe in the equity. So it becomes a conversation about the equity and less about the Twitter situation.
Well,
So,
no. But hang on. Fix it for a second, please. So let's just say he gets stuck with $30 billion, which is very possible. Okay, very possible. Okay, and he's got the $16 billion loan out there, with black and white in the K's and Q's. Right at $302, 100% of his shares that he owns are sold out just to pay the margin debt. Right.
that's
That's
right. But
that's
you
right.
would you
And
would
right. And
need
you're talking about a stock that's probably in reality.
I know,
Right.
but that's where I
So
can't really
right.
get into it, right? Like I can't tell people what the share price of something should be. Listen, it could very well get to 300, but if you're basing it on that, then yeah, there's a chance that Musk could be in a very difficult situation. But
Right.
at
That's
a,
all. It's
I agree
possible.
with you.
Right. Listen, everybody knows this. Okay. He gets a ruling against him. He's got to come up with 30 some odd billion dollars to close. He's got to go to market, sell the stock. Okay. I mean, $300, the stock's like 5x. I mean, Tesla doesn't lead in anything. They're getting killed in China. They're getting killed in Europe. Right. I mean, they've got no product roadmap. What do they have? A Model Y with 5 plants? I mean, it's not like this is
Right.
a real company here. Follow?
Right. I mean, we're talking about the Tesla stock, which I didn't want to get into that discussion. But yeah, I mean, I think that the stock is traded at a premium because of a large gamma squeeze, because of retail holders getting involved at a time where, the options activity in Tesla was greater than any other company in the Nasdaq 100 combined. There are also a lot of issues, where this people or retail investors took advantage of the split, the inclusion of the S&P 500, and it continued to rally. People couldn't afford to buy shares. They were buying stock. We've been talking about this for a long time. Volkswagen sells more EVs in Europe, but in reality, you know, I I don't think that I don't want to go out there and say that Musk is going to file. I frankly think that you would need a lot to happen in a very short amount of time. Um, and maybe we'll get to another conversation where we can talk about it in several weeks, several months. I just don't want to be saying that I agree with that, but if it's if you have a view, I appreciate your view, and I think that 99% of what you said about the situation I agree with. Um,
Yeah, and listen, sorry, I didn't take the call over. I just, I'm a C, right? So everything is risk and change management, and the likelihood from my sources, other C-level guys have fought these same cases and lost, not one, lost, right? The likely before 20, I'm putting at about 95% right now, personally. Personally, that's me. I'm entitled to an opinion. If that happened and he has to go to market with 30 some odd billion dollars worth of stock in this tape, okay, with this ugly second quarter that he's got on his hands here, okay, and Germany shutting down power and the rest of it. I mean, this tape is gruesome. You're talking about a company that's worth $50, $60 at best. It could very easily go to $300. At which point it triggers the other margin call, and he's got no stock left. That's
well,
it. It was just
I,
a risk.
yeah, it's
It's
a risk thing.
possible, right?
Um,
That's all.
I think the debt financing is in place and the equity financing was already in cash, but it is circular, and I do think he could be in a tough spot. You know, I do think that there's A stocks and KP as well. We can, love to hear what you guys have to say. And we have several people in the backlog as well that kind of wanted to chime in, both for and against, I guess, what we've talked about. I'd love to hear everyone's view.
Hey guys, I just wanted to jump in with just say one word on what you guys were just saying, but just wanted to say that without going into too much detail, but the entire street, number of banks are behind this, and for them to just walk away, on the financing side, I just don't see it happening. Banks are dying for revenue right now, and a deal with Elon Musk attached to it, is attractive to them still, even with this. So I don't know. I don't see Tesla, him having to sell Tesla stock and going bankrupt. I think that's a little dramatic. That's all. This is Elon Musk, someone with a cult following, and he can, easily raise money if he wanted to.
A stocks, did you have your hand up?
Yeah, I just wanted to not clarify but update. So thank you 3A's for that comment about the car manufacturer. So I apologize. My comment was actually just the main manufacturers based off of Europe and America. That was the data I was looking at. BMW, Germany, or sorry, BMW, Mercedes, Audi, all the American car manufacturers, and then the Asian ones. So thank you for that information on there. I hadn't actually looked at those makers. I was just personally looking at those data and being the ones that those are prevalent in America that are selling right now and impacting the buybacks and all that. That was so. Thank you. I apologize for misclarification.
Thanks.
Wait,
I mean,
except
this
you're
has been a
saying that,
lively
would you say
discussion.
that Tesla was the largest EV maker?
What
I'm
did I
not
say?
sure who said that.
I didn't say that.
Okay, because the BYD comment, I will say that about half of those cars are not just fully EVs; they are hybrids with internal combustion engines. So that number is highly debatable, but
Yeah, Tesla or
So
BYD has been selling twice the number of electric cars in China
no,
for a while
they
now.
have
The
those are hybrids
distinction is they
with
also
internal
sell a
combustion
bunch of
engines.
other electric type vehicles such as NEVs, neighborhood vehicles, and so not a big deal. Well, BYD stock at an all time. Tesla's down 50%.
BYD
So I think
sells
the
about
market's
half as many battery electric cars as Tesla.
But so I do want to jump to a new topic because I didn't want the topic to be Tesla, given, we have no views on Tesla. It's not something I spend a lot of time on personally. So, do want to move forward. I think there are a couple other people who requested. So bringing up Omar and Gerard. I think you wanted to share something, but we do have some difficulties with Twitter with Android phones. So some people may have dropped off. I'm bringing them back on. Um, Emma, while I'm trying to get Omar on, did you have anything to share or comment on?
Yeah, I would just want to say, did any of you
Oh, sorry.
have seen or tried BYD products?
I haven't. Have you tried
Yeah,
one? Love to hear
yeah,
about it.
like that was like 15 years ago when they used to make these EV scooters. So I used one before, and they usually have like one of the worst products that come from China. So this company, it surprised me that how much it actually developed and how much they produce and now. My point is, it's so much different than saying that Tesla it's not the biggest automaker, but and the EV maker, but at the same time, you bring the worst quality manufacturing in the world to compare it with the premium product. Like there is no comparison here. Like there is a different market than we're talking about it here. In the market in Asia and China, it's completely different. They want high quantity with cheap product and really, really, really low quality product. These things sold in dirt cheap. Like you can sell one Tesla and buy like maybe 50 product from BYD. So there is no comparing him like here. There is no one. Yeah, like you can't just compare BYD with by this.
I think a bigger distinction to just make is just like the internal combustion engine market is a dying zero to little growth business for everyone.
Yeah,
And that was the point that I think was trying to be made earlier. Like again, regardless of what you think about Tesla, in terms of full electric vehicles, not hybrids, not semi-electric vehicles. If you're talking about full EVs, they are still the world leader. And if you're talking about like making a dichotomy between electric vehicles and internal combustion engine vehicles, one is a exponentially growing industry and the other is a dying industry, and every metric tells you that. Like every single major car manufacturer in the world that makes ICEs is not only pivoting to invest billions to make EVs, but the growth of their ICE like the growth of their ICE portions of their businesses are all in decline universally. So I think that was the point that was being made earlier. But yes, BYD, the point that Evan made about BYD selling more only if you include hybrids is an important distinction because those are different markets.
So I did want to move. Thanks everyone for the commentary. Three Aces stock, Gerard. I did want to move on to another topic. Dufry and Autogrill just announced that they're going to merge, and these two companies were on our radar as reopening plays. Autogrill essentially runs concession stands, and thank you. I think Emma messaged as well. We had initiated on Dufry last year. Dufry operates kind of luxury concession stands within airports, so it was a way to play the recovery without, getting exposed to airlines that have unions and energy exposure and high levels of debt. And because of the European recession, unfortunately, it didn't play out exactly how we thought. Still generates free cash flow, but the merger with Autogrill, combining food concessions with and a clean balance sheet with Dufry, which is moderate leverage and as luxury concessions, it could be an interesting play on a continued reopening. Really have to go through a presentation. I'm going to share the presentation up top here. Until I have a chance to go through it, I don't have a view on what the combination will look like, what the pro forma debt capital structure will look like. But I do know that the combined free cash flow yield here, could approach, just based on my math of the individual companies, above 10%. And they are oligopolies because when you go to an airport, there are only a limited number of concessions, and you have anywhere from 8 to 12 year contracts for certain concessions at airports around the world. So it isn't something that is going to be going on the watch list. So appreciate that. I brought up Bill in Deer Point. They often have really astute macro commentary. Deer Point and Bill. We could start with Bill. Did you have any questions or comments?
Thanks, Jay, for bringing me up. I just wanted to circle back on your auto loan delinquencies. And again, I think it's early and it's definitely a concerning trend, but I just wanted to sort of make a few points on the data, right? You really have to be careful with delinquency data because it does fluctuate kind of wildly. Historically, auto loans have sort of better credit or lower loss percentages than most other loans because historically, even this goes back even during the great financial crisis, people will default on other loans before they will default on their car loan simply because they know they'll lose the car, and oftentimes that's necessary just to get to their job. So I've been looking at the Santander securitization data. So Santander is one of the biggest auto lenders in the industry, both new and used, and they tend to do subprime. And their delinquency data, we don't have their June data yet, but I would say it's increasing, but it's not out of line with their past history. You really have to look at the age of each auto
Yeah,
loan.
so that's interesting, and I did look into this. So the loans that are defaulting are actually the 2010, 2020, and 2021 vintages,
Right.
and Equifax has all the June data. If you look at the April data, there are very little defaults. You look at the May data, there are very little defaults. the June data is a step change.
Right, but if you look historically, what auto loans do is if you start a new vintage, it will start with low defaults, then it will spike, then it will come back down for two reasons. One is either the cars get repossessed, or the borrower will faced with the threat of repossession, will do what they have to do if they can, and again, they may not be able to, and this may spiral, but they will get back sort of in sort of so the vintage, the age of the 2021 receivables right now are about the point where if you go to older vintages, you'll see that this is the period usually where they start to spike, and then they sort of either come back or whatever. And then the only other last point I wanted to make, and again, I'm not denying that this could be turning into a problem. I'm just saying so far it doesn't look worse than any of the other vintages. The only other point I would make is loan volumes in 2020 and 2021 were way down in this area, right? Just simply because there weren't enough cars. Like, if you go like to most of these auto lenders, you'll see that their actual, while the default rates are maybe increasing, the amount of volume that was produced in 2020 and 2021 was like 30 to 35% less than other years, simply because there just weren't any cars to sell because of just so even if this does produce losses, you'll have to also factor that against, these are very kind of quote unquote low volume years, and so the absolute dollar of losses might not be as big as say, let's say 2018 or 2017, where there was much more volume. Anyway, those are the only
Yeah,
points I
those
wanted
are
to
great
make.
points. A couple of things to consider, though. The one way to resolve these loans is that there's there are car repossession, and that, I think, will make the problem worse, right? Because a lot of these loans were done at 80 LTV. 80 LTV, on a vehicle that sold for 35 grand in 2019, where there's a new model that currently sells for 52 grand. I think you might see problem. I think what I'm trying to lead to is that if car repos are exploding, places like Vegas and parts in the U.S. where there's surpluses, and those make it into areas like the East Coast where there aren't surpluses yet of vehicles, I think car prices overall should fall pretty dramatically. And those that were relying on, selling their old cars at a premium to places like Carvana, that is going to go away. And then this is going to hit OEMs as well, because as used car prices come down, I think, used car prices can come down by 20% plus. Like we talked about 3 months ago, Canadian real estate prices and Canadian real estate prices. I'm looking at listings, in markets where prices have gone up for no reason. They're already getting marked down 40% in certain areas. Like overall, 6.6% decline in April and a 5% decline in May already. I think, people are underestimating how fast prices can come down on the margin, because financing rates for vehicles are also, it's becoming cost prohibitive for dealers to offer 0% financing. So I think it's more about the auto sector as a whole, and how auto OEMs that were forecasting very rosy performance, may not be able to see the uplift of SAR, like 15-20% increase of sales, that people were predicting, because there's a backlog and because of supply chain issues. I think you might see a scenario where car prices come down dramatically, and it doesn't mean that this is going to be a huge consumer debt problem. I agree with you. It's a $1.8 trillion market, and if cars get repoed, that's the end of it. Your credit score gets hit, and hopefully you still have a means of transportation. I think the bigger risk is that it just affects prices of cars overall, and it affects the auto OEM sector.
No doubt, and I think you've hit the key point, which is what will this do to car values? And I can't I can't debate anything you're saying. I think it's going to do exactly what you said. The only point I guess I would just add is, I think this is similar but not the same to the housing industry, where the housing market also for during the pandemic had too low inventory in terms of houses for sale, right? So we are seeing sort of a normalization of available houses for sale. I think the same thing's going to happen in the car market. The question, which I think nobody can answer, and I think you're hitting the right point, is what will a normalization of inventory? First of all, will there be a normalization, or will we exceed normalization? And then what does that do to car prices? Because you're right, if liquidation values fall, yeah, the cumulative losses on these deals will start to increase dramatically. Anyway, I just wanted to make those points. Thanks
No,
for
that's
having me
very
up.
helpful. Thank you, Bill. Bringing Vixmon up. He's a big vol trader, exotics trader. Did you have something to share with the audience? Any comments or questions?
Yeah, I had one comment way earlier about Tesla, but I think we are way past that.
Yeah, we can move. We can move past
Yeah,
that.
so
Just
I'm
because
not
I've
gonna
been
bring
on
it up. Yeah,
spaces before that just last for like 3-4 hours, and then in the end, no one agrees. And I'd rather touch on topics where we can the purpose is free education, so we can get you know data and information out there and have healthy
yeah.
discussion. So
The
happy to.
the only thing I was gonna just mention is that with the S&P vol curve, this upward sloping around 25, 27, generally speaking, it is very bearish for volatility, at least in the short term. So you would think that on a short term basis, UVXY, which is not even a proxy of the VIX curve, seems optically low. Just be careful of spending a lot of theta right now because buying vol when it's upper sloping like this is just generally a low probability bet. And you can check what the term structure looks like by going to vixcentral.com, which some of you may know about. Um,
Yeah, VIX Central is a great site. I knew the founder. It came out in 2011. And you used to have to go on Bloomberg and look at UX1, UX2, UX3, and people didn't have access to the data. So I do think that, and one of our users is asking us to go into the CPI discussion because I do think that there could be a step change in vol next week if we do see CPI come above expectations of 8.8. But one thing I did want to share is that while nothing here is financial advice, the VIX product is actually fundamentally broken, and you can track it over time. You can look at the VIX ETFs, and this is a public service. And if you look at UVXY and you look at its performance over time, whether you're bullish or bearish on volatility, no one can argue that this thing has just been a train wreck. It was
oh,
you look at the stock price; it was over 2 billion in 2012.
yeah,
And it's 12 today. You can see that it's not meant for short, for medium term speculation, and there are better ways to express negative views on the market when
yeah.
the curve is upward sloping. You're in a contango, and as the product moves from one month to the next, you're actually bleeding because you're selling something at a lower price and buying something at a higher price. Same thing happens in commodities markets when they're in contango. But Vixmon, back to you.
Yeah, just like one extra color is that people have been wondering why, both implied and realized vol is a lot lower than people would think. I think one of the reasons is that the Barclays, made some changes to how the VIX ETNs can be created and redeemed, and that has been sort of decreasing the overall amount of assets indexed to these long like vol funds, ETFs or ETNs or whatever, and that has created sort of just a constant sort of selling pressure on the implied vol across the curve. So that's why, if you think that the implied vol has a constant offer whenever it spikes, that's one of the other reasons because the retail money has been sort of getting out of these VIX ETNs. If you can just look at the amount of NAV index to these things.
Hey, Jay, I'm going to step down, but I do think it's fair for the audience that they have the facts. I posted the article in the
Yeah, please
Nest
post.
about,
Please post it up
yeah,
top. I
I
don't.
did.
I
I
don't mind
posted the
that.
article. Yeah, listen, about EV sales, and it was rebutted a couple of times with false information. I just thought I'd put the facts in the Nest for
Of
the
course, I don't
audience,
have the
not for
data
me.
on
Yeah,
Boyd. I don't cover Boyd
yeah.
as well. So I mean, please feel
BYD,
free to
yeah.
share any data up top.
I'll send you a guy, and all he does is track data out of China, government data. I'll send you a DM with his thing. Follow him. He's really good. He gets real time live data. This is 2 weeks old now. Bide is now selling more cars, but the article is a fact. Says Bide beats Tesla in global EV
The
sales for the first
headline is
half of
misleading.
22.
Though. The headline is
Okay,
misleading.
so
Yeah.
okay, all right.
If you
So
look, if you click
again,
into
Jay.
the article,
No,
hold on,
I'm
3H's.
stepping down.
You wanted to clarify the facts, right? So if you click into the article, you'll see that it says they are classifying new energy vehicles, which includes hybrids, hydrogen
So
vehicles,
what?
and EV. So they're
So
beating
what?
Tesla by 80,000. They're doing, well, let me finish. They're doing 630. Tesla did 560. and so
Biden's
they're
stock
beating
is
them
at
by
an
a margin.
all-time high.
But those
Tesla stock
aren't.
down
Hold
40%.
on,
Who
three.
cares?
Hold on.
Seriously.
Those aren't all EVs. That's all I'm saying.
I think we're just talking
Okay.
about data here.
I mean, it's like,
Was
I
it
mean,
allergic
this is the
to the
problem with the
airline
Tesla guys.
earnings?
If I was in 100 times fake earnings, next year's earnings, I would want to know,
That's not the
what the
discussion
others
here,
started
though.
to
The
do.
discussion here is
But
what you said about BYD, which is
what
what I'm
I
saying
said
is it's
was what the headline
misleading.
said. What
The
I
headline is
said was,
misleading. If you read the
okay, so
article,
take it out
that
with the
you'll find that
publisher
out.
of the magazine.
But if you read
Take
the
it out with.
article instead of the headline, you'll realize what you're saying is not accurate. That's all I'm telling you. If you read the actual article rather than the headline, you'll quickly realize, oh wow, they mean new energy vehicles, which is a
Well,
classification.
why don't you read the article to the? Go ahead.
Well, I
And
mean, we
with
don't have
more
I don't
time
need to
context.
read it.
to
I'm
do
telling
that.
you what's in it.
Here's
Anyhow,
the thing. Hey
Jay, I
guys,
just wanted to before I
before I have
left.
to
Yeah,
move
go
people
ahead.
around, I think you guys are both make excellent points. Now, I always admit when I don't know something. I don't know Boyd. I don't cover it. So with respect, I want to move on to another topic. Um, but I think the important thing is here. Everyone here, the 630 people in this audience, are all smart enough to read articles and make decisions for themselves. So I think that when it comes to risk management, you should know what you own and understand what you own. I don't own either of these companies, so I don't have. I'm first to admit I'm uneducated. So just read the articles for yourselves, make your own decisions. I do want to move on to the next topic. And A Stock has his hands raised. I know he does a lot of vol trading as well.
Yeah, thank you for that. I just want to make one comment. And Vix Moon, I apologize if I got your name. Thank you for your comment. And Jay. So Vix and VVIX and how it's kind of been broken or quote unquote, been used to hit certain key levels. Right. I wrote an article about it. I just want to ask if I could pin it up top. Folks could take a look and read. And I know it's
Yeah,
been
feel free to pin it.
I know it's been.
I read the article. I try to subscribe to every Substack I can, and I thought you made some valid points there about volatility.
Yeah, thank you. So I pinned it up top for everybody. Just again, this is just my opinion, right? I'm not a guru. I'm not saying I'm just from contractual point of been hearing this quote unquote a lot of people talking about how they need VIX to hit 40 or 50 or those key levels, quote unquote, in order for market to bottom, right? I'm not saying we haven't bottomed. I'm just saying that I don't believe we will hit those levels in order for market to have. So again, that was my reasoning and thesis that I put together in the article. Feel free to take a look and read. And again, I do a lot of volatile based trading as well. So thank you for that, folks. Have more questions. I don't want to take up the whole space here because that's another conversation. But
Sure.
just throwing it out there for anybody who wanted to.
Yeah, I think the market can go lower without capitulation if that's the point you're making. Whether we see capitulation or not, I think only time will tell. I don't think anyone has the ability to forecast it. You could have some bad economic data. You could have this earnings season, which is starting over in the next couple of weeks. You could have companies report, several companies could report bad quarters in a row, and you could see, you know, a very bad day in the market. I mean,
So
in bear markets, you see very sharp rallies and big sell-offs. So I don't think anyone has kind of predictive ability to say that, hey, we may not have a week where, we could have another 7-8% down week. But, I think one topic that's related where I think one of my friends has done some work is with a company called Li Auto in China. And I haven't done this work, but just as a brainstorming point, this company is burning 200 million this year, has a number of related party transactions that you can look up on SEC Edgar. It's freely available to you. Has in yuan a $230 billion enterprise value, but in US dollars has a $34 billion enterprise value, and the stock has doubled on thin air. And it's gone from sub 20 to 40, and you do have you look at the Chinese EV data, and you do see Chinese EV data rally. Of course, it's coming back. 490,000 unit sales, for the country because of the fact that the Shanghai, Shenzhen, Guangdong were shut down. So I think you've had this short covering rally, and for people to do research on something like this, I think it might be worth someone's time where this is a company that's not generating um, any free cash or any EBITDA, and is traded up on thin air. So it could be something that people in the audience, could do work on. I'm not sharing, my view there, but I think it's related, and it'll help us move on to the next topic. And I want to go back to Vixmon because it's on the same vol topic that A Stocks was talking about. If he has something to share, and then we'll go back to Deer Point.
Oh no, I think the only thing I was trying to say was that in '08, the actual implied VIX implied vol top occurred much earlier than the actual market bottom, which was actually March '09. So what I was saying is that the peak fear often, happens 1 or 2 quarters prior to the actual, the um, I guess the tradable bottom. And in this case, you could kind of argue that, we did actually hit VIX over 40 very briefly, back in, I think, Jan or Feb or something like that. And maybe, this is what you're seeing right now is like the slow, the grind down and the, low sell vol sell stock type of a environment. The only way I can see VIX reclaiming the, 40 plus levels is if we get a new source of fear. And I don't think that's inflation. I think it has to be something that no one's really even pricing in. And I wager that it would be like a even broader scope escalation in geopolitics. I think that's the main thing I can think of. I think the earnings is kind of like a known fear, right? So I don't think it's sufficient to drive the extra peak fear. And I think the reason
Well,
why I argue that
earnings, I think people who are educated have an idea that earnings, are going to be lower, but the extent to which they're going to be lower is unclear. And I see talking heads on CNBC saying, "Oh, the market's at a 17 times PE." Well, that's a 17 times PE on Morgan Stanley's 225 earnings. And what if that 225 earnings comes at 190, and we're at above
yeah,
a 20 times PE with 3.5% neutral rate? What is the market going to do then? And they're also like unknowns, right? When you see a lot of market volatility, things start to break that you don't realize. So we saw in Japan, Kuroda, depreciate the yen, at the fastest rate since 2001. And for those who want to know where we're getting this VIX data, I just posted VIX Central screenshot above. Free resource for you guys to look and see whether the VIX curve is in contango or backwardation. I'm not affiliated with the website. Take it for what it's worth. But going back to this, there are a lot of risks that people aren't really thinking about. I think the energy minister in France this weekend said that we might be in a situation well before the winter where, I know we talk about Nord Stream, but, we could see energy pipelines in Europe, completely stop sending gas. And I had one, subscriber call me and tell me, "Hey, I have like 3 years of wood supply." Like people are rationing, how many hot showers they take a day. In municipal parks, industrial companies are already being shut down in Germany. So I think that and when you look at Turkey, I think the Turkish lira could go to 30 now with all the inflation and issues in that part of the world. I know that commodity prices came in a little bit, but they've started to rebound already. We haven't even had the energy shock. People think we've had the energy shock, but the oil embargo really hasn't even taken place yet in Europe, and gas hasn't been shut off yet. So
yeah. So I think
keep in mind with Turkey, 46 billion of Turkish debt is held by Spanish banks. I spent some time in Spain when the cajas were blowing up, and there were banks in Spain lending to carnivals, which tells you moving carnivals, which tells you the type of underwriting the banks do in Spain. But if that 46 billion of Turkish debt, because of a sharp depreciation in currency, where these Turkish debtors have to pay twice as much in interest and principal, they default on their debt, just like people are walking away from their cars, right? In the US, you might see contagion in Europe, right? And Euro's also going to parity. What is that going to do to inflation in Europe? And Europe could be in for a big stagflationary recessionary situation. So I am a very positive person, but I can see right on the top of my head that in a period of volatility like this, where there is uncertainty, that dominoes can fall and you don't know where exactly they're coming from, going to what you're saying.
Yeah, just one thing, just want to clear up is that uh, I think we all agree that there's some the sources of known fears and unknown fears. I think we agree that if we have additional unknown fears, I think that's what would drive the implied vol higher. Only thing I would say is that in the 2000 to 2002, the Nasdaq cycle, if you look at the VIX chart, it actually never really blew off the top like above like 45 either,
Yeah,
and we had a
but
massive drawdown in the Nasdaq, and I think that can show you that you can have a very ugly delta sell-off, but not like a commensurate vol spike like you had in COVID.
Well,
where
there's also a lot of dispersion there, right? So
exactly. So
look at the
like
value, like
dispersion is
Warren Buffett's
Yeah, but
portfolio in
high
2000
dispersion.
did
I
absolutely crushed it.
Yeah, I mean
I
like high
think that
dispersion generally is very bearish for vol because like for example like if you
Well,
have
that's why
oil.
2000 played out the way that it
Yeah,
did.
but nobody's talking about how illiquid long variancy contract, and that happened after the GFC. So to sit here and try to make parallel like like compare and contrast between like the early aughts and now, I mean, nobody's buying long variance contracts. They're so illiquid. So everybody who's like a long volatility fund is buying short dated options, which because of theta decay, even on relatively small drawdowns, they have to monetize those and roll forward. So like this whole idea, and then you have the whole negative gamma situation, and the cure for negative gamma is higher implied vol. But like there's been a lot of weird things that have happened. Like even if you looked at the term structure, like almost 1 year back, it was at 40. And it should have been inverted. It wasn't. And so like the whole and I'm not even an equity vol guy. I'm a rates vol guy, but like which is completely different anyways from the way that you trade it. But like this whole idea of like implied vol, I don't even think what's going to happen is what happened in '08, is where you have people hedging, therefore implied vol is relatively tame. You also have a lot of vol like being kind of like, extrapolated into other areas. It's going into FX vol, it's going into rates vol, it's going into commodity vol. But what's going to happen is people hedge, and when there's enough hedging, that kind of suppresses volatility. But then what happens is you get this second systematic leg down, which in '08 was a solvency crisis, and then you have jump risk, and nobody's hedged to protect against that, and then you have volatility blowout. And so what you're waiting for is some sort of secondary leg down, and that could be solvency, that could be some sort of contagion risk, where you have the second leg down. People are tired of hedging because hedging's becoming extremely expensive, and nobody's hedged. You have that second leg down, then you have this jump risk, and then everybody's upside down because they're not hedged for that. But like this whole like the tameness and volatility, I think is a very complex topic. Sorry, I just had to kind of hop in there because nobody talks about what's happened to long variancy contracts. Like, I mean, they're completely liquid. Nobody can get long variancy contracts.
Actually, dear point, I'm happy you brought that up. And Vixmon, I want to hear your view as well. This has been a really great conversation. I don't think individual investors often get exposed to, theoretical vol discussions, but I'm going to spend 2 seconds explaining first what the VIX is. VIX is essentially, front month volatility of S&P 500 options. It is a theoretical construct. You can't actually trade the VIX. Investors trade futures on the VIX, and they trade ETF products on the VIX, and they can buy put and call contracts on VIX futures through ETFs. There are also there are a number of other products. To your point, did you want to explain what a variance contract is and how it works? If not, I can explain
Uh,
it.
yeah,
Vixmon, you can go ahead.
yeah, I mean, I used to be the market maker for the variance. I'm not going to name the bank, but uh, basically, variance. What we're talking about variance, we're talking about variance swap, and you're basically one party is agreeing to pay the realized vol, right, over say the term could be like 1 through even 10 year, and that would be calculated based on some type of a formula, usually log variance, and then the other party is agreeing to take the other side of that by paying fixed. So it's kind of like a interest rate swap in that sense. One pays floating and the other pays fixed, and it's traded OTC. But I guess for this conversation, to make it more relevant to this audience, we're asking why are vols so tame, and that's because back in '08 there were so many systematic short funds that all their job was to sell the long dated variants. So when vol blew up, basically the entire like the all the short funds short vol funds had to cover, and 5 year 10 year variance went to like 45 or something like that. Just think about it, right? You could sell implied volatility of S&P for 10 years at 45 volatility. So it really squeezed to extreme levels in retrospect. Currently it is nowhere near that because there's really no buyers except for large like insurance companies, and the only sellers are Goldman and like Morgan and these guys, which mark their own books. So in some sense there's not that many as many players as before, but the importance of like the long dated variance is that it kind of determines the overall like S&P vol curve, including the 2-year and 3-year, which are listed on SIBO. So ultimately, no one's going to take the 2-year and 3-year options higher than the 5-year OTC variance levels. So at the end of the day, when the for the entire vol curve to spike up, you would need much more levels of short, and I just don't see that right now. Not many people are systematically selling vol, and the only people that are owning vol are the short-term hedgers, and they have to monetize. So whenever implied vol spikes up, they are quick to monetize because over time, people realize that if you don't monetize, you're not going to actually make any gains. That being said, I heard that 50 Cent, the VIX call buyer, is back, and overall, like he doesn't actually have a good track record in terms of timing ball spikes, but I would imagine that there's plenty of demand still for the convexity. So if you were going to buy or bet on VIX spiking, I would do what 50 Cent is doing, which is buying the convexity stuff and not really paying a lot of theta owning the at the money options. Okay, I guess that's all I got to say.
That's a great point, Vix. I'd like to talk to you after all. You got some good.
Dear point, you're back up. Sorry, I think you might have an Android. So A stocks, I think you're making a point, and I'm bringing up a couple of new speakers as well.
Oh no, I'm good. I just I like the way Vic said it about the buying. That's something that's all.
Yeah, I mean the names that the way that we like to play bearish is I like to think that it's very difficult to have a directional bet on a broad index, right? Who is going to be the sharpest guy, who's going to short QQQ at the exact right time after 30% drawdown? Who's going to be the smartest person in the room who's going to short SPY at the exact right time, right? Are you playing for 1 to 2% move in a week? Are you playing for a 4 to 5% move in a week? The way that we've been doing it is we've been finding SPACs with very high pipe to float ratios. We talked about the six stages of the SPAC life cycle, right? From IPO to DA to post DA to X redemption to essentially ticker change and then the post vote. And what we've seen is, there are names with pipe to float ratios where hedge funds are trying to sell out of these public private investments in public equity to finance some of these private deals where the pipe to float ratio is 400, 500, and one we're talking about this week is 1800%. And then 6 months down the line, management is allowed to sell out of their ownership along with the VCs that did these deals at 50% premiums. And they sell out, and you saw names during the Russell rebalance 2 weeks ago that were down 30-40% in a week. I think finding companies that need to raise capital that don't generate free cash flow, that had deals done in 2021 through the SPAC structure that, when those deals were announced, valuations were much higher, I think is a really interesting way to short the market and hedge your portfolio without actually directionally playing a big index. Because every week, even in a bear market rally, some of these unlocks can result in positive alpha. To your point, you had your hand raised. I think we had some Android issues if you wanted to share.
Yeah, sorry, I kind of caught the back end of what Vix was kind of talking about, which was the variance swaps. But yeah, I mean, it's kind of like the stock talk's going to be like, oh, here we go. I mean, they're very similar to like cross currency basis swaps and like all sorts of like you have fixed, you have fixed floating, you have floating fixed, and so like but I kind of heard the back end of where Vix Mon was talking about that. Then when I tried to come back up, it was like I couldn't hear anyone. But the one thing that I did want to kind of touch on was the dealer aspect of this, right? Like so if you even look at Citadel and these people who hold that let's say that the short gamma exposure, they're obviously delta hedged, but even if you start to look at like what dealers are doing, you're starting to see that that the competition for individual dealers is declining, and so therefore I just think that it's there's that systematic risk there, right, which is either gap risk or jump risk, and so I just think that if you start to look at the equity volatility market, like a lot of people are just stepping back because they don't want to be kind of reliable for that exposure. And like I said, I mean, it's much different than interest rate, like trading interest rate vol, where you have like positive roll between spot and forward, and it's kind of like FX differentials, and that's actually why I prefer interest rate vol, because you don't bleed like you do with equity volatility. But like I just think that the equity volatility market now is just so suppressed, and I also think that that is broadly a function of rates volatility, and FX vol, and like most of that rates gamma stuff is all done OTC, right? It's all over the counter. But I think that higher levels of FX and rates vol is kind of allowing this inability for those to settle, which then I think after the settling of would be a tick up in equity volatility. But like the equity vol market's just like completely broken. I watched like Ben Eifert. He was kind of talking about one of his strategies that he did back in the beginning of COVID. But like even if you listen to a lot of these equity vol guys, it's just like I think that the whole equity volatility market is just it's completely broken, like I said, because longer term variance contracts have become illiquid, and then you also have this whole other like kind of aspect of people just having to get into these shorter tenured options, which I think is probably the main cause of lack of rise and vol. But yeah, hopefully, sorry about that. These phones are really shitty. So
No, no, I can sympathize. I had to buy an iPhone just so that I could type and do other work while I was on these spaces. Otherwise, with an Android, you need to have your hand on your phone the entire time. For a $30 billion company, doesn't really make any sense. Stock market news adding you back.
oh no,
Um,
no, I the thing is I'm on an iPhone, but there'll be like these times when I come back up and then I can't hear anyone. Like if like I'm like,
Happens to me too.
yeah, it's like the weirdest. Yeah, it's weird.
all right. Well, Emma, you haven't had a chance to share. I'd love to hear your thoughts. I know you have a lot of interesting topics that you post about.
So I've actually been trying to listen while moving the shower, but on the Vols point, I just thought to point people to Squeeze Metrics. They've done a lot of so I think on Twitter, if you search in
Yeah,
the box,
absolutely.
yeah, they have so they look at the dealer side of things, and when you have a bunch of retail traders buying short-term calls on something like GameStop, they end up having to be on the other side of those positions. And so the way Squeeze Metrics looks at it, they look at the dealer positions and how the dealers would have to then get out of those like talks, because the dealers don't want directional exposure. So if the dealers are all short GameStop calls, short-term GameStop calls, they're going into the futures markets and buying GameStop. And so that it around the March events of the whole COVID thing, the big spike in vol where we saw it go to like 80. What you could have if you looked at the different the different strikes that were available, and the positioning, squeeze metrics. I wish I had like a better explanation right now that I could give to you, but it's all like explained, like where it stopped, where it went to. This is on SPX, but you could see it again when we had the whole retail craze start. I mean, I don't know that it's ever ended, but the big shakeouts, kind of, if you look at the dealer positioning, it really shows what's going on. And what it looks like that means, though, in the long term is, see, it looks like equity volatility is suppressed, but it's really just like it's like suppressed and ready to explode, basically. And there's a book written on it by it just came out not that long ago, by Hari Krishnan, also a guy I always recommend. He also wrote another book called Second Leg Down, which is a great one on how to say you find yourself in a bad position and you were long equities and they're falling apart, you hadn't hedged yourself yet, a way to save yourself somewhat using options. That's what Second Leg Down is about. But he's written another book, and I'm struggling to get the name of it. But if you look up Hari Krishnan financial its author, then you'll find it on Google. But that
Well,
one
thanks
just
for
started.
sharing that. I'll find
So
that book and I'll post it up for people. And please go ahead.
Yeah, I can do. I can.
Okay, yeah, feel free to do that, Emma.
Perfect. And I
Um,
can also post some YouTube links where he specifically talks about this. So what I was just trying to explain to you, a far better job. I think you guys will find it very.
great. What?
so one thing I want to add to Squeeze is a great thing. They monitor what's called GEX, however you want to say it. So low GEX or low GEX is one way to look at it, is causes higher volatility, and a high GEX reading is anything that stifles volatility reading. That's a metric they track and they post. I don't know how much they post free and paid anymore. I used to use that service a while back. Great service. And then they also track DIX prints, right, which is another way of knowing how much buying and selling, quote unquote, is going on from a larger scale, right? So one thing to point out is in June and July, the GEX has gotten higher and suppressed, and the DIX has picked up, right? So what that means is there's buying going on somewhere in the market, right? And the volatility is decreasing. And you can see that now with the way the VIX, although it's broken, has been subsequently going down, down, down. And every trader who posts their charts talks about how it's broken key levels and it's compressing and XYZ ABC, right? All of that kind of adds up to what? There's buying happening somewhere in the market. There's hedging happening somewhere in the market. Whether or not that sustains, whether or not that holds, is what we'll find out in the next month or two.
Yeah, great. Well, thanks for sharing. We're going to move on to next topic. We'll call it, macro at a glance. And what we've seen um, is that, for next week, we'll post this. We have a number of important economic data points coming out. I think one that is underrated is the NFIB Small Business Optimism Index, and that has come down pretty dramatically over the last 3 months, and it's supposed to come down to 92.5 versus 93.1 for last month. And we have MBA mortgage applications, which is obviously forward indicators on home buying in the US. And last month we saw a negative 5.4% print. I would not be surprised if we see another negative print. There might be a last leg of buyers that is, or, sellers that are trying to lower their price to get deals done. But overall, I expect the MBA mortgage applications index to be in a bearish trend. And we have real average hourly earnings coming out also. So MBA is at 7 a.m. on the 13th, NFIB is on the 12th. On the 13th, we have real average hourly earnings, which is an insight into wage inflation. And it was a little bit softer last month. So it'd be interesting to take a look at this because CPI is coming out at the same time. So CPI month over month is supposed to be up 1.1%. As you guys remember, last month we were calling for a 9% CPI print, and I think next week could be the week that you see it. And just that leading into the July 27th Fed meeting, I don't see how the Fed could not raise by 75 bips after seeing CPI 9%. So I think, at least for the month of July, we're going to be we're going to continue tightening financial monetary policy at the same rate we have been in the past. And I think what's even more interesting is that core CPI is still expected to be, close to 6%. I was just based on year over year effects, that should be coming down in the fall. But because of, one point we talked about earlier, because of the Delta variant, inflation slowed down in the months of June, July, August of last year. So the year over year comps are going to be pretty easy for inflation to overshoot until, we hit September, October, November, where the year over year comps become difficult because again all you're looking at is a basket of goods and the change in price year over year. So that's going to be really interesting. And then we have PPI on the 14th, which is a forward looking indicator. That is forecast also to be up 80 bips month over month, and it's likely to hit almost 11%. You can see, it doesn't compare anything to Germany where CPI is 30%, but in Germany, it's predominantly energy, given energy prices are up literally 5x since 2019. And just to wrap up next week, on the 14th, we also have initial jobless claims. And we saw, the yield curve inverted last week. That's something that we haven't really talked about, the twos tens curve, which isn't as important, right, as, the shorter dated curve versus the 30-year. But the twos tens curve inverted for, I think, the third time this year. And earlier in the week, you saw recession probabilities rise pretty dramatically. And I think we saw some positive labor data come out. And I did want to spend 2 seconds on labor data and why the unemployment data last week was, it looked very bullish, but in reality, that data was I think it was overly bullish, and I think Fed governors may interpret it as, hey, the labor market is really strong, when in reality, underneath the hood, the labor market is not as strong. So to provide a clear data point, on July 8th, we saw non-farm payrolls come in at 372,000 versus expectations of 265,000. And obviously that looks like we're adding jobs at a very rapid pace. But what was not shared, while this was 170K above expectations, the labor force shrank pretty dramatically. So one thing to note when you come to unemployment data is there are various types of unemployment data. There's U3, there's U6. What the government reports is U3. And the difference between U3 and U6, just to provide you so you understand what's coming out, the unemployment rate is the percentage of people who are unemployed and available to work. It is expressed as a percentage of unemployed people in the labor force and is expressed using different rates. What you see the Bureau of Labor Statistics come out with is U3. It's watched every month, and it's considered to be a barometer of economic conditions in the U.S. This is also, the Fed looks at everything, but they're setting U3 when they're saying, unemployment at 3.6% is too low. We wouldn't mind if it goes to 4 to 5%, which means the economy could slow. The criticism of the U3, which is what you see in the news every day, is that it's too simple. And many economists believe it doesn't take the whole picture into account because it only includes people who are actively seeking unemployment. It excludes what they call discouraged workers who are working part-time but want full-time work. So an example is, if there's like a engineer or an electrician that wants to work and can't find electrician work but works at McDonald's, right? That is a discouraged worker, and there's a big actually lack of electricians, but you get the idea. If there's someone working part-time and wants to work full-time, or another example being a marketing executive laid off by a tech company, right, at age 57, who works now as a property manager, and because he was subject to age discrimination and is a discouraged worker, he wouldn't fall into U3. So U6 includes a much bigger swath of unemployed people, and it's something that we monitor at Special Sits News because it's a much truer, natural, non-technical understanding of what it means to be unemployed. And the U6 rate, which is also published, for anyone who wants to know, it includes people who are seeking employment within the previous 12 months and have been unable to secure a job and are still looking. So the U6 also provides, an insight into the underutilization of labor in the country. And the key data last week, was that the U3, benefited, but in reality, the labor force shrank by 350,000 people. And the fact that there wasn't more of a focus on this shows that the broader market, especially as the yields on the 10-year widened, missed the point that the labor market shrunk by one of the biggest amounts in the last 24 months with the non-farm payroll numbers. And another thing to point out is that the U.S. average work week decreased to 34.5 hours, the number of hours worked per week. So that had peaked at 35 several months ago, and that has slowly been coming down every single month since the mid of 2021. So, just to point out, we saw the yield curve invert and then uninvert as, just so that there are different people with different types of experience in this space. The yield curve is essentially, the sequence of rates, the 1 year, 2 year, 5 year, 10 year, 30 year. Banks borrow in the short end of the interest rate curve and lend out on the long end. And yield curve inverting is negative for the economy because it means that, one, the outlook for growth is declining, and two, finance companies aren't going to be profitable by borrowing at the short end, lending long, which will suppress credit. So the fact that we inverted, I think we'll probably invert again. And the long end will, at some point, will be a buy, which can be, expressed through TLT or, buying muni closed-end funds at discounts or a number of other products. But you can express that view, when when it becomes more certain that the economy is going to slow down materially or enter a recession, the long end of the curve comes in before the Fed has the ability to cut short-term rates, and the yield curve essentially inverts, predicting rates are going to be cut because the economy is going to go into recession. So that's something that I think individuals wanted me to touch on. And I think that in the near term, as inflation exceeds expectations, we might be peaking in the next 2 or 3 months. No one knows for sure. We'll flex our views as the data changes. but we might see some widening before the ultimate tightening. So, slowly we've been adding, to our TLT to close-end muni funds, locking in yields. To be very frank, having cash as a hedge. I know we talked about hedging, variance, VIX, et cetera. I eschew a lot of the volatility products. They're really easy ways to lose money. The easiest way to hedge your portfolio is to have cash. I mean, they're even, believe it or not, CD accounts where you can lock in almost 3% today. You know, um, and having cash, as a margin of safety, not knowing where volatility is going to take us, as the earnings recession is the next stage of this. We saw a rate move and its effect on duration, long duration stocks, unprofitable companies that shouldn't be valued at the multiples they were valued at, and were only valued there because of a zero interest rate environment and government transfer payments. You're going to see the next leg, which is how the economy is going to slow in reaction to asset prices falling, in reaction to consumer spending falling, which is 70% of the economy because of inflation. You're going to see deleveraging, right, in areas of the market. You're going to see fewer car sales. You're going to see car prices come down. You're even going to see housing prices come down. You're already starting, even in places like Texas, you're starting to see price concessions in the time of the year where you're supposed to see more residential home transactions. So, listen, no one here has a crystal ball. We're all kind of sharing ideas, and some of us, may be, more educated in certain sectors versus others. But I think this is, an area that's right for a discussion. And I see that Deer Point has his hand raised. So Deer Point wanted to go back to you.
Yeah, I'll try to make this concise. For CPI, I think CPI is going to start to come down. I wrote a Substack on like deflation, and I talk about the spread against the PPI minus the CPI, and some of those things that we're starting to see. But something that's very interesting that David Rosenberg put out, and for anybody who isn't familiar with him, he used to be chief economist of Merrill Lynch, and now he runs his own boutique. But he found that the corporate sector, the U.S. corporate sector, has passed 4 years of pricing into one. And so, what he is saying is that this idea that the PPI is going to rise, not really going to continue into perpetuity, because if you've already packed 4 years of price increases into 1 year, how many more price increases can you theoretically do? Another thing that I talk about in that post is if you look at from April of last year to April of this year, the 1.6 trillion in consumer spending came from a 1.5 trillion dollar drawdown in personal saving and a $120 billion increase in credit card debt. So obviously math adds up there. And so what you're seeing is that this ability for consumers to continue to eat that cost of higher costs that are passed on by corporations is declining, and it's declining quite rapidly. And so I think that this idea that, PPI or CPI will remain elevated, we're starting to see that peak. If you look at, the 10-year treasury against the 10-year break even, which is considered the real rate, that's now positive. I think it's at like 40 basis points. It's not extremely positive, but it's still positive, and this is what people are real rates. And so, like, once I start to look at all of these factors, I think that you're starting to see the market kind of pricing in declining inflation expectations. Even if you look at the 10-year break even, these are starting to come down. I think it's at 230 basis points, so slightly above the Fed's target, but still you're starting to see this kind of expectations of inflation start to ease. My final point to this is kind of to I've been in the camp that the Fed will end up pivoting. If you look at the CME June 23 futures, those have come, the Fed fund futures, those have come down. They spiked up last week because on Friday because of the JOLTS data. Outside of any, because besides that employment data, I wasn't too worried. Something that I have been watching is the 2 5s 10s butterfly. It's a little bit more complicated, but basically what you're looking at is, you're looking at the belly of the curve relative to the wings, which would be the 2s and the 10s. And so, there's different ways to play that, even if you're trying to kind of if you believe, for example, the curve becomes more humped, then obviously you'd want to sell the belly, which is that 5 year, which would be yields up and the price down, and buy the wings. And if you think that it's going to be less humped, you would want to buy the belly and then sell the wings, which would be yields down, price up. And obviously, if I'm in the pivot camp, I'm sure people can kind of think of where I would be kind of structuring that. You've also seen Eurodollar futures start to price in like rate cuts. So I think that the market's kind of starting to change sentiment, that the Fed is going to continue on the rate hike cycle, because I think you're seeing such a slowdown in global growth. You've seen a slowdown in new orders across different PMIs. This came on the back of large increases in inventory. So obviously, if you're sitting on a ton of inventory, you're not going to place in new orders, right? So there's all of these kinds of things that are starting to come through that I think are pointing to slowing growth. And yeah, I think that CPI will not be relatively high for much longer. And then the employment data, I think you kind of covered everything there uh, terrifically. I also look at the PMI data for employment, because I think of that usually as more of a leading indicator. Also, a lot of employment data is lagging. Um, yeah, I think that that's everything that I kind of wanted to touch on. But again, I wouldn't suggest that people go try to trade 2 5s 10s butterfly. That's a little bit more of a like complicated like fixed income strategy, and obviously you're not trading the actual. You're trading more like the curvature than you are than you are the actual slope of the curve. So there's weird things there, but yeah, I think that that's also pointing possibility that the Fed's going to be cutting, because last time I looked at it, it wasn't quite inverted, but I think it was at 5 basis points. So yeah, I think a lot of things start to slow down. So I know that was a bit of a monologue there,
No,
but
that was very helpful. So, we're in the same camp. I think in the fall, it's inevitable that you see some of these inflation metrics fall, but I did want to make a point where it may not come down as fast as the Fed needs it to be. I'm not in the camp that we see a pivot in September. I do think that we might see like a 25 bips print versus 50 to 75. And the reason I say that is that even though OER is a lagging indicator, OER can be a third of CPI and a little bit less when it comes to PCE. But rent and real estate price inflation, even if prices come down, which by the way they're not, rents month over month they're actually up 3.2% reported, and so rents are up 23% year over year, and you're still seeing wage inflation in certain sectors, while in other sectors it's coming off. And the headline layoffs you're seeing in the tech sector, I think you'll start seeing in construction and other sectors, but predominantly in 9 of the 11 sectors. Still have a very tight job market. You have 11 million open jobs, 1.8 jobs for every person seeking employment, and that is the highest I've ever seen it. And I think it has to get closer to one before you see unemployment start ticking up rapidly. But OER is only 5.5%, which means you know owner's equivalent rent, which is just a poll the Fed does, and ask people, how much rent they could charge for dwellings. It's completely based on a survey, is not realistic. It usually operates on a 5 quarter lag if you read kind of empirical papers that are written by Fed members. So, our view is that OER goes to at least, 9-10% this year. And what that could mean is that, if it's 30% of CPI, you could see 1.5, 2% um, you know, increase in CPI while, other commodities are flat to down a little bit. So what that means is you might actually see, I agree that we might see inflation peak this year, but it may come down a lot slower than people realize. Everyone's kind of looking at commodities and saying, "Whoa, oil was at 130, now it's at 104, and it was as low as 95." And copper and steel prices, which are forward looking indicators for the economy, we always look at Dr. Copper. They're down 12-month lows, but copper and steel and oil are not a very large percentage of consumer spending, right? The biggest bucket of consumer spending is rent and real estate, and wages are a huge component that the Fed is looking at. So until we see those roll over meaningfully, I don't think you're going to see. I think you're going to see numbers peak, but not enough for the Fed to take its foot off the gas pedal. Um, and I think this time is different. And by the way, even more important than equity prices and, you know, two, 20, 30 basis point changes in inflation has been the credit market, where the spread to worst has already surpassed the wides of 2018. It is actually more expensive on a risk adjusted basis to borrow as a high yield company, so the thousands of companies with ratings below triple B minus, than it was in 2018 after 500 billion in QT. The market fell apart. Amazon was down 35% in 3 weeks, and the bond markets were shut down. The loan market went to 93, 94. The loan market's already at 92, and that's a floating rate product. It means that there's a lot of fear in the market and or a lack of buyers. And you look at fixed income fund flows from mutual funds, and you're seeing mutual funds see $5, $6 billion of outflows across IG and high yield. And we've posted a few of those graphs on our timeline. In equities, we've actually still seen equity inflows. You're seeing equity inflows into products like ARK. You're seeing equity inflows into tech mutual funds, into consumer mutual funds, into healthcare mutual funds. People are still putting money into their 401ks. We're not at a point where, there's kind of peak fear in the market. It's unclear whether we'll see it in the way that it has in the past. We're not at a point where, while the bond market is shut down, an interesting point I wanted to bring about that is we might be close to bond and loan markets being fully shut down, but I think we have more wiggle room than we had in 2018, because in 2018, companies didn't have a chance to refinance. And during COVID, every single company and their cousin refinanced because interest rates were low and it was kind of the thing to do. Banks weren't making any money off M&A because there's so much uncertainty. So every banker, making 2% off a high yield bond or a leveraged loan deal was pitching these deals to companies. Hey, take your 2021 maturity, your 2022 maturity. Now that the Fed has put $6 trillion of bank reserves into the market, and rates are artificially low, why don't you refinance your debt out 3, 4 years? So maturities have been pushed out. So it's not going to be a situation where you see 10% plus default rates like in '08. Not just because, of the severity of the downturn, but also because maturities have been pushed out. So I would, one of the things that we're monitoring is I think it will, if credit spreads widen out another 100 to 200 basis points, it will be impossible for companies to finance even in the loan market. And you have seen a lot of loan deals get done, fewer bond deals. If the loan market also shuts down along with the bond market, I think that will be a big catalyst for the Fed to at least slow down the pace of tightening. So it's something we're really focused on. Emma, I think you unmuted.
Yeah, and so loan market, you're also seeing some issues that, point in the direction that you're talking about. So Bank of America has been very aggressive in the leverage loan market, particularly with SPACs. I'm sure you're aware. And I guess the news is there's like $40 billion on bank balance sheets. A lot of it we think is on Bank of America. Bank of America's balance sheet in hung loans. So for deals that, like Twitter or whatever, that didn't they took the risk on their books, made the leverage loans, and now the deal's not going through, and they can't. These loans are being quoted as low as 92, 89, 88, and it can only go as they sit there on the books of the bank. It's not going to go up. So yeah, these hung
No, that's a
loans.
great point. That's a great point. This happened in 2008 as well, where a lot of these banks, financed LBOs, leveraged buyouts, where private equity sponsors come in, they bid on a company, they lever it up 3, 4, 5, 6 times, depending on the sector. It's kind of like when you buy a house, you put 20% down and you build equity, using your 5 times leverage, very aggressively, right? With small percentage changes in the value of the property or as you pay down debt and delever. It's the same idea as an LBO. An LBO is when a private equity company puts 20, 30% down and takes a public company private, or buys a private company that's growing from another private equity firm and adds additional debt to it, right? And the way that Twitter was being structured was originally the original structure was with a reasonable amount of debt, and it looked like almost over levered. I was questioning, are they going to be able to service interest expense? And that's why the layoffs would have had to happen. But I digress. Going back to the situation, these banks take the risk. Oftentimes, when they do a committed financing, they will underwrite the loan. They'll keep it on their balance sheet and then syndicate it out to investors like collateralized loan obligation funds, CLOs, insurance companies, pensions, mutual funds, etc. And different loans have different risk treatment. So loans that are triple C aren't eligible to be bought by CLO funds because they have triple C buckets and they prefer to buy loans that are above triple C to meet their various tests like a WARF test and triple C tests. So they're the biggest buyer of loans in the market right now. And right now, S&P and Moody's, the upgrade to downgrade ratio, there are more companies getting downgraded, obviously, because of declining margins and lower expected earnings. There are more companies getting downgraded. The first month was in April. The downgrade ratio was higher than the upgrade ratio for the first time in 2 years. And what you're seeing is as that continues, right, there are going to be less good loans for these CLOs to buy. There are going to be more companies that are downgraded, not just to junk below triple B minus, where insurance companies are priced out, a lot of them, but below triple C. And it's really going to be at that point where the loan market shuts down. It could be several months away. A lot of companies that issue in the bond market, they're just saying, "Oh, we'll just do a loan at a higher rate, and we'll assume that LIBOR will come down. It's high now, but if we enter a recession, the front end of the curve will come down, and we'll bite the bullet and issue a loan at L plus 600, which is LIBOR plus 600 basis point spread. And when the market turns around and rates are lower, we'll just refinance it, and we'll avoid the fixed rate market. But when the loan market shuts down that I think the Fed is going to pivot. And what is the definition of pivot? Pivot doesn't mean the Fed's just going to jump and do QE again. I think that time is past us. I think the Fed realizes. I think this is why we're going to see a slower recovery than the snapback rally of COVID. And again, it's not advice; it's just anecdotal research and opinion and commentary. But I do think that the Fed saw the mistake they made in keeping QE going for as long as it did, and I doubt that after announcing 3 trillion of quantitative tightening, that they're immediately going to start cutting rates and doing QE. They might slow down the pace of rate hikes. They may actually reach whatever their neutral rate is. For Kashkari, the neutral rate is 2%, right? For Bullard, the neutral rate is 3.5%. So let's say the neutral rate is somewhere in the middle, right? No one knows exactly what it is. And no one even knows whether it's in that range. But if it's close to that range, you might see and the market's even pricing this in, 2 or 3 rate cuts, 50 to 75 basis point cut of rates next year. But that also doesn't mean we have QE and all these unprofitable stocks rally 500-600% again. So I think people also have varying definitions of what pivoting actually means. And it's important to realize that pivoting doesn't mean that it's April of 2020 again. So, with that, wanted to quickly move to the next topic. And the next topic is going to be, what what we expect, from earnings season. And the earnings season, going forward, I think is going to be a pivot point for the economy. I think we had shared our view on the tech economy with investors right now, and how they're interpreting data from sell side. So the sell side, when you see people referring to it in the news or on FinTwit, is a host of bulge bracket banks, JP Morgan, Morgan Stanley, Goldman Sachs, Credit Suisse, Deutsche Bank, etc., and some smaller banks like Jefferies, Imperial, Odeon, and others that publish their research about the economy, single stocks, credit, etc. And what you've seen is a number of these banks have downgraded their economic outlooks severely, right? So like Goldman went from like a 3% economic growth outlook for fourth quarter to now 0.9%. And you've seen even outside of the bulge bracket banks, you see the Atlanta Fed and Atlanta Fed GDP expectations of negative 2%, right? And that was just last week. And that was after, ISM data. So I think you're getting, a number of information. And I think, we were discussing this with one of the speakers very recently here, but, I think it's starting to become more consensus that there's over a 50% chance that Europe and the US could see some kind of economic slowdown. And I'll actually share for you so that everyone can see it, a link to the Atlanta Fed GDP now, and it was at negative 2% at the end of June, and now I think it's negative 1.2%. It oscillates, every few days. But I'm going to share it up here at the top so that everyone can just see it and understand what we're referring to. Because I'm surprised that more people don't know that we have the Atlanta Fed forecasting GDP growth every year. A stocks going to go to you before going to the next topic.
Yeah, sorry. I just wanted the audience to be aware why it shifted from -2 to -1.2, and that was it. The non-farm payroll numbers being better than expected. Obviously, there's a caveat behind that, but that was a big reason for that pivot upwards, meaning a lower negative print to a smaller as a comment.
Yeah, no, definitely. I think we touched on that um, a little bit earlier. So I think going into um, we're going to be publishing an earnings calendar later this week, and I think what we're going to be seeing is in earnings season, the first companies to report are the banks, and the banks are going to paint the picture for how the rest of the economy is going to perform. Last quarter, the banks were actually more bullish, and then earnings later in the quarter were bearish. And I think this time we're going to see, banks could actually be more negative on the economy. You saw Jamie Dimon, who is the CEO of J.P. Morgan Chase, do a complete 180. And he said, "Oh, the economy is going to be strong." I don't know if you guys remember that earlier in June. The economy is going to be really strong. And all of a sudden, he was like, "Hey, I expect I expect a catastrophe, with the consumer and funding markets and lending markets." So that really surprised me. Um, and for Diamond, who's always pitching his own book, to be that negative, being one of the most conservative underwriters in the syndicated loan market and in the public capital markets, I was frankly very surprised by that. So I would expect trading volumes to be lower. I think that hedge funds have been forced to deleverage. I think that their prime brokerages have raised repo rates for funds that are highly levered, like Citadel and Millennium. I think that we're likely going to just see lower trading. I think you've seen funds blow up, um, and which means lower volume. And I think you're going to see less lending when it comes to mortgages, right? So Wells Fargo is one of the biggest mortgage lenders. So I think you're going to see volumes and outlooks come down there. So this might not be a great quarter for banks. And at the same time, you remember a lot of the investment banks, J.P. Morgan, Goldman Sachs, Bank of America, Morgan Stanley, raised compensation to multi-year highs, right? You have base salaries for first-year investment bankers, well above 100,000, and you had a catch-up in inflation on the wage front, so you're going to see margin compression at these companies as well. So I'm not very enthusiastic, for this earnings season. I think it might be the quarter where CEOs realize that they need to reset expectations. We used to call it in the industry, throwing the kitchen sink, because CEOs get paid based on, top line revenue growth, EBITDA growth, and EPS growth. And, it is very clear to me that in the first quarter, apart from companies like Restoration Hardware, where the CEO had like a absolute fit on the earnings call and said the world was going to end, that was absolutely absurd. Um, I think you're going to see CEOs that were unclear about the outlook for the year revise their expectations lower. And 40% of CEOs on earnings calls last quarter said they're concerned about inflation, slowing growth. You might see that tick up. And you might see the sell side, which is all pretty bullish at 225, 215 EPS. You can all do the math in the audience. If the S&P futures are slightly down, but you're at 3880, you divide that by, consensus, let's say, 215, you're looking at 18 times earnings. But if, that comes 10% lower, right? And let's say we're at, or to make the numbers easy, 190 of S&P earnings, right? And you're still at 3,900, right? All of a sudden, the market starts to look more expensive at almost 21 times PE. Stock market news, I see your hands up, so I'll take a break and throw it to you.
Yeah, I was just going to quickly add to that point. Like, empirically, I should know if Micron, MU, if their earnings were kind of the end of last one or the beginning of this season. But I did think reading
Yes,
what they
that
did.
was a decent, go ahead, stock market news.
No, you could. I was just gonna say that like they came out and said like our forward revenue is down like 30% from what we were guiding for before. I thought it was interesting for me to see how the stock moved. Last quarter it would have felt like that would have been down 20%, 25%, but Micron was only down like 8%. So I kind of really think that fits into your narrative, Jay, where these CEOs might take that chance where it might be less of a hit than other quarters.
I think you're absolutely right. That's a very astute point. So I remember Micron reported on June 30th, and they had their Q3 webcast, and like after hours, I was like, okay, well, earnings were like outlook was terrible, and the stock's down 5%. And I think what you might be seeing is if more CEOs get the confidence to do that, this might be the quarter where a number of them reset expectations. But in the semiconductor sector, and we've been bearish on semiconductors. I mean, you're seeing home builders are another category. Both categories are down 40%. The idea was in semiconductors, I think a lot of the street was already bearish because, for example, in a car, whether you're an ICE vehicle or an EV vehicle, numbers have gone up dramatically for the number of semi chips in a car, right? 1,600 to 3,200, depending on the model. That's an unbelievable amount of semi chips. So what do you do as a car manufacturer and OEM? You over order, right? If you're, building 1,000 cars every 3 months, you order for 2,000 cars. The idea is like over the year, you're gonna be getting your chips twice as fast, and you just double order, or you triple order. What that did was it's resulting in inventory gluts. There's misunderstanding of demand. People are building more foundries. Within 2, 3, 4 years, you're going to have a surplus in semiconductors. You might actually see that the last year was a cyclical peak in valuations for semiconductors, even though they didn't really look that expensive. People keep forgetting that these are cyclical industries. And that doesn't mean that Micron isn't a great company. It doesn't mean that Micron doesn't have great management. But I think, the point you made earlier is right, that, you might see these companies underwhelm, and depending on the sector, right, you may not see a 20 to 40% decline on a big miss, but with certain companies, you might actually see surprise reactions. So, like when it came to Target and Walmart, if Target and Walmart, right, which are not, haven't really corrected as much, if they miss and you see consumer risk or correction there, because a lot of the lower end people who make below the average income will shop at those places, right? You could see a bigger decline or bigger correction in companies like that. You could also see, bigger declines in companies like Apple, which has been a really cheap hedge, where handset sales were down 40% in China, for example, right? A big market, and a lot of the country was shut down. And the iPhone 14 isn't really much different than the 13. And yeah, it's a big index weighting, but if they do underwhelm, it's unclear, right, whether they do, but if they do underwhelm, right, that stock might have more downside than a company like Micron. So this overall, I think, whether you're bullish or bearish, I think you're going to see, management teams have no choice but to face the truth and to bring down their expectations. And it's unclear whether stocks are going to be down 10, 20% on those types of big revisions, because a lot of it's been priced in, or you're going to see very sharp revisions. And I think it's going to be different based on the sector. But I am very excited about this earnings season. I think it's going to be a surprise. And there are some executives on this call today, or former executives, and I think the consensus amongst, you can look at small business confidence, and that's why I'm interested in tomorrow's data that's going to come out on the NFIB. CEO confidence is a big driver of business spending. So right, so a lot of the B2B spending, and that applies to a lot of these enterprise software stocks. A lot of the B2B capex spending, that's a big driver of the economy, and it's almost a one-to-one correlation with CEO confidence, how much they spend on capex. So again, we're running late on this call. I was planning to go through an earnings calendar and talk about a few different names. We'll do that on the next one. But I do want to leave some time for questions. Going to bring some people up who hadn't had a chance to speak. But I think for the next call, I think spending some time on the earnings calendar and what we expect is going to be a big part of the call. But there are two new speakers up here. Um, Tekla Girl and I'm Shankar and Sydney. So Tekla Girl, please go ahead. Oh, it looks like you might have an Android. Not sure what happened there. Please feel free to request again. I am Shankar and then Sydney.
Hey, sorry, Jay. Actually, we covered the topic I was interested in very early on
Oh,
in the.
I'm Shankar. Okay, I see. No problem. Sydney, go
Thank
ahead. Sydney Stock Blogger. If you're having technical difficulties, we're just going to touch on one more topic, and then I think we'll wrap up. And the topic is commodities. So what we've seen is we've seen a lot of volatility when it comes to the commodities markets, right? Last week we saw cotton, wheat, copper, steel, oil. All you saw the Goldman, the DB, the UBS commodity indices all down 15% from the highs. And at the very end of the week, you saw a reversal, and we saw natural gas rally. You saw an inventory print that came in like 20% below expectations, 60 BCF versus 72, 73. And natural gas was up like almost 20% in a day. If you look at today, from the lows, 540 lows, we're at 634. 634, we can all do the simple math, divided by five. We're up, 17, 18% from the lows. And that was, for guys who were short, that was a face ripping move. And we saw something similar with oil where we bounced off 95 to 105. And I think what the market is trying to share is that the commodity issues are not over when it comes to energy. I think some of the corrections in ag metals, those were expected, and that is because growth is slowing. Even demand, believe it or not, for agricultural commodities declines in recessions because restaurants stop buying. Restaurants also waste a lot of food, and commodity prices are very sensitive to 1 to 2% changes in supply demand. So if demand's down 1 to 2%. I mean, you saw with the decline, with the shutdown of Freeport, which is only 2% of natural gas production in the form of exports, a 2% decline for 3, 4 months resulted in a 40% decline in the commodities. So you realize commodities are much different than equity prices. They are priced on a curve. They're not forward looking like equity prices are. They're not looking 6 to 12 months out when you're looking at the front month. So the sharp bounces we've seen in energy are because of the geopolitical situation that is continuing overseas, and that could get worse. So I think it's frankly really interesting. And one of the commodities that we do look at, which I think is more so indicating that we're entering a recessionary period. You can pull it up as LMCA DSO3 commodity, the 3 month rolling forward copper contract on Bloomberg, and I'll post it up for you guys so you can see it. It's almost a 45-degree line straight down from April through June. And this is, something that, for the last 20 years, I've called Dr. Copper. Dr. Copper, is showing that the economy is weakening dramatically globally. And it's not the US predominantly. It's really more so Japan. And that's why Kuroda doesn't care that the yen is in free fall. And Europe, where they might have the biggest recession since '08. And it may be supply driven, but I don't think that matters. So I'm just going to post this Dr. Copper right to the top of this so that people can actually see the data and visualize what's happening. Just take 1 second to post it up here. And I see that someone in the audience has just shared, a few other charts that, I think I'll post after this that show, how severe the correction has been for base metals. And one other interesting thing to note is that China is one of the biggest buyers of commodities in the world. They account for like 60% of base metals and coal imports. And what we're seeing is that the Chinese economy, although they're recovering and they're trying to do stimulus, the stimulus that they've already enacted is nothing like what they did in 2015-16. And their growth rates have slowed down to 4%. And at 4%, the Chinese economy is actually in a quote unquote recession because unemployment lags. Their labor market structured a lot differently than ours because it's an export driven market. So it doesn't necessarily, they don't actually need a technical recession of 2 quarters of consecutive negative GDP to actually see an increase in unemployment. They're seeing big increases in unemployment already. So that I think is an interesting thing to focus on. And I've seen a number of investors kind of reach to China because of there's a reason why it's outperformed developed market indices, and that's because they're lowering interest rates and increasing fiscal stimulus at a time where every single continent and country in the world outside of Japan and China is tightening monetary policy. So, in fact, Japan is loosening monetary policy so much that it's actually negatively impacting China if you look at yen yuan. But we'll get into that on another call. We're at a point where you're seeing a number of opposing signals in the commodity market where base metals and ag are weakening, which show that we could be in a global recession in 2023. But something that is very negative is that energy commodities are bouncing pretty hard. And I think that's going to put more pressure on Europe and is going to result in, especially if Nord Stream shuts down, that Germany could have to shut down a large part of its industrial sector going into the winter as people won't have fuel otherwise to heat their homes. So A stocks, you have your hand raised.
Yeah, I just want to make one comment. I'm not sure how much people are aware of this, but the seven main provinces of China, which is Guangdong, Jiangsu, Shanghai, Fujian, Zhejiang, Xinjiang, and Shandong, account for 80% of Chinese. And the other statistic that folks should know is of those regions, one third of Chinese population is built into those seven combined. So if you have seven main regions that are about 80% of the export, right, and they're, like you said, they're demand driven, a major impact to the Western world and the Western countries, and one third of the population is there. And there are certain provinces that are re-shutting down again from this weekend, which is another topic for another story. Just the impact to keep in mind. That's really sharing. I have some of those pictures. I can post them later. I haven't posted one to
Sure.
share off the top of my head.
Thank you for sharing. Another aspect when it comes to commodities is, gasoline prices have been high, not just because oil prices have been high. They have been stubbornly high because of the fact that refining margins have been the highest in many, many years. And we ask, why is that? Why are refiner margins so high? And, this is negatively impacting, so many people. It's specifically because refining capacity in the United States has also come down very dramatically, to the tune of, and I think there are many educated individuals in the audience here, but in the to the tune of almost, I have the exact figure here, of 4 million barrels per day of refining capacity has come out of the market. A lot of it happened during COVID, where some older refiners, we haven't really built a new refiner in 40 years, came off the market. And, because refining capacity is down, refiners take crude oil and they refine it into distillates and into gasoline. You've seen, diesel prices up, to $6 a gallon. And you've also seen, you've seen gasoline prices, also at relative highs. And I think that until you see, and I think Biden was talking about invoking the Defense Production Act, there's no way you can get refining capacity up that quickly. So it's not just the fact that oil prices are high, it's also the fact that we have a lack of refining capacity. And, that continues to be a risk when it comes to distillate, home heating, diesel, transportation shipment, um, input costs. So it's something to just keep in mind. We just actually did a piece on Phillips 66 for subscribers where, discussed, what are the valuation drivers for its chemical business, for its midstream business, for its refining business. And, PSX, trades at 7 times normalized earnings, is underperformed below by 40%, is positioned to do, $500 million share buyback. You could even do a pair trade, with U.S. refiners and European refiners to hedge out some of the crack spread risk. But it's a company that will benefit from spreads being higher, especially on the distillate side, because it has more exposure to distillates and diesel than it has exposure to gasoline, where I think demand may slow down faster. And if you look at the utilization data, even with which is provided by the DOE, U.S. refinery utilization rates reach 94%. So it's not like there's slack and these companies are trying to game the system. Year-to-date averages have been closer to 90% during refinery maintenance season. So the prices you see at the gas pump and at the diesel pump today are with refineries operating at almost you can't. I've never seen utilization much higher than 94%. So from a commodity perspective, I think these are some really interesting data points to understand. When you think about the implications for Europe, I was just doing some work on, I won't name the company right now, but European chemicals, special situation. And, chemicals companies often have commodities as inputs. And, I think that, in a stagflationary environment, a lot of these companies, I think, if you look at GS, Morgan Stanley, Credit Suisse, Citi, we're looking at over a 50% chance of a euro area recession over the next year. And chemicals tend not only to be cyclical, as there are inputs into industrial processes, but they also have commodities as input costs. A lot of them have natural gas as an input cost. In fact, even agricultural fertilizers have natural gas as a big input cost for nitrogenous fertilizers. So if you have a spike in natural gas, a big one in Europe, as pipeline flows completely shut off, you could have a scenario where a number of these companies are very negatively positioned. And the European market is a lot different. The stock market is a lot different than the US in that it's more exposed to industrial consumer, whereas the US is more weighted on tech. So, in an environment where rates come down, we enter a recession, you might see a scenario where tech, healthcare, and defensive sectors and even utilities outperform industrial, cyclical, consumer, and a lot of the value stocks that have outperformed for the first time in the last 3 quarters. Um, because value hadn't outperformed growth for the last 15 years. So, when it comes to factor exposures, I think this is a discussion that I think will be really helpful to individuals in the audience. But with that, I think the next call, for next week, we'll focus more on the earnings discussion. We'll focus more on kind of individual name discussion, not advice, but just discussion of different names. And we'll follow up on the Twitter saga because I do think that when it comes to SPACs, I do expect, price volatility in names like CFEI Rumble. I expect price volatility in DWAP. I do expect there is a new X Redemption SPAC short opportunity that I'm going to be sending out later tonight. And there is a new merger arb scenario with a 20% spread, $21, a pretty fat spread that I think is going to take about a year to figure out. It's not Microvision, it's not Microsoft Activision, but it is a deal that I think is going to play out over the next year. I want everyone to have a wonderful night. Thank you for listening and sharing your thoughts and ideas. Whether you're bullish or bearish, or you like a sector or you don't, I think having those conversations is very healthy. As long as conversations don't become agnostic, antagonistic. I think these are healthy discussions, and people are learning and benefiting from them. So, education is something that's really important to me, and I hope that you guys were able to take at least one thing from the call that you learned and can improve your life or your asset allocation or your risk management or just your education. So have a wonderful night. We'll talk again next week, 6 p.m. Thank you guys for listening to this YouTube video. If you liked what you heard, please give the video a like. Make sure to subscribe and hit the notification button so that you are notified whenever we upload a new video for you. Also, check out our website at specialsitsresearch.com and check out our Discord for weekly trade ideas and live events. We have a community of over 3,000 professional, semi-professional, and new traders that contribute their ideas across our various Discord channels. We're working really hard for you guys and hope to provide more. Thanks.